Silver is soaring, but miners aren't. Here's why that matters. Silver just delivered one of its strongest single-day moves in years, jumping more than 3% in a single session. That kind of move immediately grabs attention, and for good reason. But while the metal itself surged, something very unusual happened beneath the surface. The silver mining stocks barely moved. And historically, when silver rallies hard and the miners fail to confirm that strength, it's not noise, it's a signal. Today, I want to break down exactly what this divergence means, why it's happening, and how to approach this moment strategically, without panic, without hype, and without ignoring the warning signs. Part 1. Silver is doing everything right. Let's start with what is working, because silver on its own looks incredibly strong. From a price action perspective, silver has clearly reasserted itself as one of the strongest performers in the precious metals complex, outperforming gold and many other commodities. A 3.35% daily move is not something you see often in a mature market, that AS momentum. But price is only one piece of the story. Investment demand is accelerating rapidly. Exchange-traded funds backed by silver have seen roughly 40% growth in inflows year to date, showing that both retail and institutional investors are increasing exposure. On the supply side, the situation is even tighter. According to data from the Silver Institute, the global silver market is facing a supply deficit of approximately 180 million ounces, marking the 5th consecutive year where demand has exceeded supply, 5 years in a row. That's not a short-term imbalance. That's a structural one. Industrial demand is a major contributor here, and it continues to grow. Solar energy alone now accounts for about 20% of total silver demand, and that share is still rising as renewable infrastructure expands globally. Silver is no longer just a monetary metal. It's an industrial necessity. When you step back and look at these fundamentals, rising investment demand, persistent supply deficits, and accelerating industrial use, silver is doing almost everything you would want to see in a bull market, which makes what's happening next even more important. Part 2. The red flag. Miners aren't confirming. Here's where the warning light starts flashing. On the same day silver surged more than 3%, silver mining equities, as measured by the SIL ETF, were flat to slightly down. In a healthy bull market, this is abnormal. Silver miners are what we call a high beta exposure to the metal. Their costs are relatively fixed, so when silver prices rise, profit margins should expand rapidly. That operating leverage is why miners are typically expected to outperform the metal itself during rallies. History supports this. During the 2010-2011 silver bull market, silver roughly doubled, and silver mining stocks tripled. That is how a confirmed bull market usually behaves. But when miners fail to participate, it often means something else is happening under the surface. We saw a similar divergence in 2016 when silver prices continued higher, but mining stocks failed to confirm the move. That divergence preceded a sharp correction in silver prices. Now, to be very clear, this does not mean silver must crash tomorrow, but it does mean the market is sending a message. When the producers of a commodity fail to validate the strength of the commodity itself, investors need to stop and ask why. Part 3. Why this divergence is happening. This disconnect is not primarily about silver being weak. It's about mining companies facing pressures that the metal itself does not. One of the most misunderstood facts about silver production is this. Only about 25% of the world's silver comes from primary silver mines. The remaining 75% is produced as a byproduct of mining other metals: copper, lead, zinc, and gold. That has massive implications. It means most silver miners are not pure silver plays. Their profitability depends on multiple commodities, hedging strategies, and complex cost structures. And those cost structures are under pressure. Mining companies are dealing with rising fuel and energy costs, higher labor expenses, inflation across equipment and materials, ESG and regulatory compliance costs, declining ore grades, and reduced global mine supply. On top of that, many mining companies use hedging programs that limit upside exposure to silver prices. These hedges protect against downside risk, but they also cap profits during strong rallies. Add in sensitivity to a strengthening US dollar, and you have a situation where silver can rise, but mining margins don't expand as much as investors expect. The result? Mining stocks lag even in the face of strong silver prices. This is not a failure of silver fundamentals. It's a reflection of operational reality. Part 4. Exhaustion signaling. What the market is really telling you. Professional traders and institutional investors have a very specific term for the type of behavior we are seeing right now in silver and silver equities: exhaustion signaling. This concept is often misunderstood, so it's important to slow down and unpack it. Exhaustion signaling occurs when an asset continues to move higher, sometimes very aggressively, but the supporting components of that market begin to lose participation. In this case, silver prices are surging, yet silver mining stocks are failing to confirm that strength. When this happens, it suggests that the fuel driving the move may be changing, or at least becoming less uniform. This does not automatically mean the market is about to collapse. What it does mean is that the rally may be transitioning from its easy phase into a more complex one. Early in a bull move, prices rise easily because skepticism is high, positioning is light, and new buyers continuously step in. But as prices rise and sentiment improves, markets often reach a point where momentum alone is no longer enough. At that stage, the market may pause, consolidate, or rotate capital internally before deciding on its next major direction. Exhaustion signals often appear just before short-term pullbacks that reset sentiment, sideways trading ranges that frustrate both bulls and bears sector rotation, where capital moves from one part of the market to another. What's important to understand is that exhaustion is a condition, not a prediction. It's a message from the market saying, pay attention. Ignoring the signal would be a mistake, but reacting emotionally to it would be just as dangerous. The correct response here is awareness, not fear. Patience, not panic. Observation, not overreaction. Part 5. What to watch next. Turning signals into information. If this is a moment that requires discipline, then the natural question becomes, what exactly should we be watching? Rather than relying on opinions or emotions, it is far more effective to focus on a small number of objective indicators that can help clarify whether this divergence is resolving or worsening. First indicator, silver miners, SIL ETF. The silver mining sector itself is the most obvious place to look. One key level to watch is the 20-day moving average, currently near the $85 level on the SIL ETF. If miners are able to reclaim and hold above that level, it would suggest that participation is returning and that confidence in mining equities is improving. On the other hand, continued failure to reclaim this average would indicate that investors remain hesitant and that downside risk remains elevated. This isn't about predicting price, it's about watching behavior. Second indicator, the gold to silver ratio. The gold to silver ratio provides important context for relative strength. If the ratio continues to compress, meaning silver is outperforming gold, but silver miners still fail to participate, that's a sign the divergence is becoming more severe. It suggests that while investors are comfortable owning the metal, they're unwilling to take on the operational and equity risk associated with mining companies. That kind of behavior tends to appear during transitional phases in the market. Third indicator, the US dollar index. Finally, the US dollar remains a critical external variable. A sustained move above 108 on the dollar index would likely increase pressure on mining equities through higher input costs and tighter financial conditions. Even if silver prices remain firm, a stronger dollar can compress margins and dampen investor enthusiasm for miners. None of these indicators offer perfect foresight on their own, but taken together, they provide context. And context is what allows investors to make rational decisions rather than emotional ones. Part 6. A balanced strategy for an uncertain phase. So how do you position yourself when the market sends mixed signals like this? One of the most effective approaches in uncertain environments is balance. Balance doesn't mean indecision. It means acknowledging risk while maintaining exposure to opportunity. Rather than going all in on mining equities or abandoning them completely, a diversified structure allows you to stay engaged while managing downside risk. For example, you might maintain around 60% exposure to silver itself, either through physical holdings or metal-backed ETFs. This keeps you directly tied to silver's strong supply-demand fundamentals without the operational risks of mining companies. You might allocate approximately 30% to carefully selected primary silver miners, focusing on companies with low production costs, strong balance sheets, and silver as their primary output rather than a byproduct. And finally, holding about 10% in cash provides flexibility. Cash isn't a drag, it's optionality. It allows you to take advantage of pullbacks, add exposure selectively, or simply remain patient while the market resolves its internal tensions. This kind of structure allows you to benefit if silver continues higher, while also protecting you if volatility increases or miners continue to lag. Most importantly, it puts you in a position to act deliberately, not react emotionally. Conclusion: signal, not sentence. To be absolutely clear, the lag we are seeing in silver mining stocks is a serious near-term warning, but it is not a death sentence for the silver bull market. We have seen similar setups before. In 2020, silver miners significantly underperformed during key phases of the rally, only to surge more than 200% once confidence returned and the divergence resolved. Markets don't move in straight lines, they move through phases. What we are seeing now is a phase that demands attention, not abandonment. Silver's long-term fundamentals remain intact. Supply remains constrained. Industrial and investment demand continue to grow. The structural case for silver has not disappeared. The real question right now is not where silver is going, but when and how the next phase unfolds. If you stay disciplined, informed, and patient, this signal becomes a tool, not a threat. Thanks for watching. If you found value in this analysis, make sure to like, subscribe, and share your thoughts in the comments.